Thank you so much, Wael. The debate is about what we look for in growing. Being a lending company, technically, we need a lot of capital. There are many options out there, but for early stage startup, it does go down to debt that is done within the venture world. So we have two people. Firstly, we have Armie, who's representing PFG, which is very well known to be one of the pioneers of debt globally. She's the co-head of FinTech with PFG, and she also leads the region MENA and Europe overall. So Armie has been there, done that, many deals around the world, including Saudi Arabia. She really understands it, and she's representing the status quo. On the other hand, we have Arsalan, who's a partner at Tenami Capital. Tenami believes that debt is done in a wrong way for startups, and therefore they have an alternative solution that they believe can solve the problem much better than the traditional solution. So I'll ask both of them to give a quick intro into how they do what they do, and we can take it from there on individual questions. So I'll invite Arsalan first to give his proposition of what their product is and how is it really different.
Thank you, Abdullah, and thank you, Raed Ventures, for this opportunity. When we set up Tenami Capital, we saw that as financiers of the venture capital space, we kept on pushing for innovation in companies. But there was actually no innovation happening on the venture financing side. And this is where we attempted to develop something differently. So the two key pillars which make us different from venture debt is, one, we don't have a fixed amortization schedule or linked to interest rates, but instead we take a share of revenue. If you think about COVID, the performance of the companies were heavily linked with the actual underlying dynamics. And we don't believe that a central planner sitting in Washington, D.C. should be deciding what that rate of return of capital should be. It should be linked to the underlying performance. That is one key pillar of our structure. The second pillar is we have an agreed debt for equity swap agreed on day one. We have seen that whenever there is volatility in cash flows and distress, it leads to conflict, and conflicts destroys value. So we try to solve this by having that agreed debt for equity swap on day one. So thank you.
Thank you so much, Arsalan, for the quick intro. Armie?
So we're PFG, Partners for Growth. We have been providing credit facilities globally for going on 40 years. We spun out of JP Morgan in 2004 and have been doing what we did all along and continue to do the same. Effectively, we're providing credit facilities in various forms and functions. They can be anything from a term loan to line of credit to acquisition financing to asset-backed facilities, right? So very structured facilities that are tied very closely to underlying assets, whether they're receivables or hard assets like vehicles. They're sort of tailored to build those assets up. Our structures are, again, every deal is different. There's literally no two deals that look alike. We can do Sharia compliant structures, we can do traditional structures. It's sort of all over the map, very much customized to the opportunity. Fundamentally, though, it's credit. You have to pay it back. It's not permanent capital, it's unlike equity. And so there's an obligation to pay it back. And the underlying schedule of how that's paid back is different deal by deal as well. We've been in the region actively for going on 6 years. We've done about 11 deals here. We've deployed roughly 320 million in commitments in debt to those companies. Representative companies are Tabi, Trucker, Sayara, Apontia, Baizat, Husby, etc. That's us.
Very interesting. Thank you so much. So the debate is structured such that I, as Buildnow's founder, I'm looking at both these options. We are actually literally looking at them as well as of now out of the right setting and questioning them on a few parameters that make the most sense for us. So I think the first thing that we really try to understand is, fast-growing company, we need a lot of capital, and we need to understand how much can each of your formats can give us, and what is that based on? Is it based on GMV? Is it based on assets under management? Is it based on revenue? For our model, for example, our revenue is what you see here, and it's not the gross margin that we make technically from a legal perspective, or is it that SaaS type of revenue that you look at? Because this changes the conversation significantly for us to who to go with in terms of the size. And then the next question comes immediately is, okay, if you start at point X, how can you go up? And does the parameter change when we go up?
I can start. So for a company like yours where you're building a book, you have a loan book, right? Our structure would likely be tied to that loan book. So it would be what we call an asset-backed facility. As that loan book grows, we continue to grow with it. And so the capacity that we can provide is anywhere from $1 million to, we had 110 million plus in Tabby. So it's a very broad range, and it can scale with that book's performance. If you're talking about a corporate facility, so not necessarily tied to the assets, but at a level, at the corporate level for various purposes, then the analysis on how much we'd provide you there is a bit different. It would be tied to revenue, it would be tied to your growth plan, and what we think is an appropriate level of debt for you to be able to service and pay back. But the boundaries are anywhere from $1 million again up to, well north of 50.
Yeah, I think that's absolutely true. It has to be customized for the business. So we have a very close look at the cash flows. And we do anywhere between $1 and $5 million on these transactions. And for us, what we want to focus on is the alignment of interest. And we want to be able to ride the volatility with the company. So if you have higher sort of growth, we also benefit. If your growth is lower, then we also sort of take the downside risk in terms of lower returns. So for us, the alignment of interest is critical, and then we look at the right matrix. It could be revenue, it could be your cash revenue, but obviously it has to be sustainable for you to be able to make those distributions. So I think we look at it similar to our Armie is saying, on a customized basis. But the key element is we want to be aligned with the company. If it does better, if it grows faster, we benefit more. If it grows slower, our returns are also lower.
I hate to burst your bubble as well, but we could coexist in the same deal. So I don't know how debatey this is going to be, but for example, you heard their capacity. It wouldn't be very useful in building your book, right? But we can be building the book with you, and he can provide you something that's tied to revenue, and they can coexist. They're used for different purposes.
That makes sense. That makes a lot of sense. But I think one thing, just to compare them individually, so on the Tenami Capital, one thing you said is you do revenue-based. Your website, the first thing you say is revenue-based.
Correct.
Isn't that capped by itself, by the nature of it, given that if you classify our revenue as the net revenue that we take? So you can give us 20, 30, 40, 50% of that. You're not going to give us 100%. For us, which is a lending business, I cannot grow with less capital or 50% of what I did last year to 10x this year. It can't happen. So how do you solve for that?
So for us, what is important is the business plan. So when we talk about our investment criteria of minimum 5 million revenue, we have to look at what is your run rate and what is the capacity to do, right? So it doesn't have to be that you must have generated 5 million, but if we see that path, we have the cash flows to see it. That's why it is future driven. But in order to sort of explain simpler at a headline level, we make sure that if you have 5 million in revenue, we are happy to do it, and we would do anywhere between 20 to 50% of that. But obviously, in a business which is accelerating very differently, such as yours, then we would also be looking at the forecast and trying to understand those drivers, because that financing will be leading to your growth. So again, it would be customized based on that piece, and then the cash flows we look at carefully to look at your distributions which are possible in there.
That makes a lot of sense. Thank you so much. So I think the next thing that we really care about, so we understood the amount, the scaling of it, and then sort of the structure of what you guys do, is the price itself. So the price on paper is one thing, and the price in terms of the amortization, the cash drag we'll need to have to make provisions, this becomes, the net price becomes something very else, very different. And I think one thing that adds to this is definitely the warrants. Which PFG or the traditional venture debt does take, and what I understand Tenami's model does not take. So what is the true cost of funding, or what is the IRR that you guys look for?
The difficult ones. It's an easy answer for you. You are equity. Yeah, so our target return is 20% IRR. So between the income on the facility and the warrant, that's what we're targeting. Generally speaking, our rates are sort of low to mid-teens. So the balance is something we hope to achieve through the transaction that yields return on the warrant. That's effectively our structure.
And for us, given it's revenue linked and we have a cap return, so it can vary anywhere from 15% to 25%, depending on how the volatility of your revenue. So if you're growing faster, we also make more money. If you're growing slower, we make less money. So our IRRs and cost of capital is very closely aligned with your performance of the company.
Okay, all right. So yours is it's almost like floating rate, is how well we do. You take a percentage of the revenue itself. But how does it work for us, who's a lending company again and not a product-based selling a particular item? Is because the more we sell, the more loss-making we become technically, because you are taking a percentage from the top. So it's not aligned with us growing that fast or growing in the manner we should be. So how do you solve for that?
So for us, in one of the key investment criteria is a path to profitability, a fully funded business plan. So when we look at cash flows, we not only look at your revenue, you look at your working capital. Do you have negative working capital? Do you have positive working capital? Are there any other levers you have? So it is a function of your cash flows, not just your revenues, and whether with our capital, you get to that sustainable path. And our terms of distributions are not monthly, they're also semi-annually, which allows a little bit more time. So if you have a business plan where, for example, you're not profitable, you have to spend a lot of resources in scaling it and then achieving profitability, then it may be too early for debt in general, or maybe for us. But once you're at a path where you have product market fit and you have an engine which is working, then it makes a lot of sense. And I'll give you an example. In our last transaction with Golden Scent, which is one of the largest fragrance perfume providers in Saudi Arabia, they have very high margins, 20-30%, because this is a category which does this, right? And if they turn their inventory 3 to 4 times, they make 80% return on investment on capital which goes through. They have an engine which works. So for them to pay 25% on a return on investment of 80% makes perfect sense because it's non-dilutive. So again, it will be company specific and making sure that both of us are aligned in those returns.
Just for us, in a very simple form, you're paying for what you're using, right? And you're only using what actually supports your asset pool. So as the loan's growing, you're drawing to support that loan book. You're not overextending yourself by drawing too much. It's closely aligned to your book.
That makes a lot of sense. Thank you so much. So I think the last point, which is probably closest to the heart for entrepreneurs looking at the COVID era and the downtimes that can obviously happen. What happens in a worst case scenario? Things don't go well. Am I going to be shut down because I have to pay, or all of my company is a collateral? Or what are the scenarios around that? How do you build for that?
So for us, if there's been if there's something that's fundamentally wrong, right? Let's say you've defaulted on a covenant. We will contact you. We're obviously closely in touch anyway. We'll have a conversation about what the fundamental issue is, the underlying issue. Most of the time it's timing, right? You didn't get a contract, you didn't deploy as quickly as you thought you would. And so that's not an issue for us. We kind of work with the company and say, okay, let's see how you recover. If it's systemic, you maybe launched in a new country and that country some regulatory change happened and it's affected your business, then we'll understand. And so you revise your plan and we adjust the covenants, et cetera, and we move forward. If it's catastrophic, your business has just completely failed. In that case, our philosophy has always been to work with a company to figure out how to exit. Do we wind down the book in your case, because it would be a loan, it would be an asset-backed line? Do we wind down the book? How do we do that? We work with you to do that. Do we find somebody to sell you to? Do we, we kind of think through all of the strategic angles, but we work with the company. That's been our philosophy for 40 years. We're not very heavy-handed if there's a major issue.
So I think for us, this is the key innovation, because we've seen that whenever there is distress, there is conflict. And not all stakeholders may have the same view in preserving value, especially in a technology-driven, founder-backed businesses. So for us, the way we solve for it And this is actually where, if you look at debt funds globally, they make a lot of money is when you have a debt for equity swap. So for us, we agree that debt for equity swap on day one. So if your company is worth 100, we will say your collateral value is 50. So if you can't make that distribution, we will receive those shares and we will dilute the other people. So this is the partial collateral payment. So in that scenario, what we see is that all the stakeholders still aligned, and we can continue to preserve the franchise value, because there could be a time where the company and the equity enterprise value exists, but because one or two stakeholders may have a different view, that enterprise value can be completely wiped clean. So we want to make sure that we agree those points up front. In times of distress, how are we going to react, rather than wait for that to happen.
Very interesting, guys. So thank you so much. We'll have to get into a close now. So I think very interesting points from both the sides of the table. Very different product, but definitely we also believe that they can definitely work together. We need a lot of capital. As long as the terms make sense for our business and for startups in general, we're happy to take those risks and sort of mitigate that as well with different sort of things coming together in the same bucket. So thank you so much, guys, for coming, and thank you so much for listening.